and let me know where you are tuning in from today. Go ahead and just type that into the chat box. And also let me know if you've ever heard of Maverick Investor Group before, or if this is your very first experience with us. Go ahead and type that into the chat box and I will be able to see that. That's how we're going to be able to communicate together throughout the webinar today. And I'm going to definitely take live questions at the end of the webinar. What I wanted to do today for people that are brand new from Maverick, first of all, let me just really quickly introduce myself and my company. As Linda said, we are a licensed real estate brokerage. We specialize exclusively in helping people to buy turnkey out-of-state rental properties. That's all we do. We've done it for over 15 years. That is our niche specialty, okay? We've been featured in a lot of the different real estate investing press over the many years, won different awards, and we've been doing just one thing and one thing only, helping you buy turnkey rental properties in the most investor advantaged markets, regardless of where you happen to live, okay? So that's what we do. And the way that we built that business model is on really 4 primary pillars of value, right? 1, we want you to be able to buy in the most investor advantaged markets, regardless where you happen to live. We don't think you should be geographically restricted to your local area. You should be able to buy in the best markets. Number 2, we think you should be able to buy turnkey rental properties that are either brand new or fully renovated, and they already have a tenant in place. They already have local property management in place so that you don't have to be the rehabber or the landlord. Number 3, we think you should be able to access off-market properties that are not available to the general public. So Maverick Investor Group presents private buying opportunity events where our clients can buy off-market turnkey rental properties. And finally, we think you should have the deals come to you so that you don't have to spend your time out there looking for them, right? So that's what we have been doing for the last 15 years. We've worked with a lot of people in the Realty 411 community, and it's been a really, really fun time for us. And so super excited to be back today. What I wanted to do for this webinar is do an educational event, because there has been a lot of all sorts of commentary in the mainstream media about the housing market and are we going to have a crash and what's going on with mortgage rates and what's happening with inflation and all this kind of stuff. So what I did for today is I compiled a whole bunch of the latest data that I'm going to present to you, okay? And we're going to go through and rock through a number of different topics. And we're going to start off talking about why an imminent housing crash is not likely. Then we're going to talk about the benefits of today's mortgage rates for rental property owners. Then we're going to talk about why the advantages of single-family rental properties are turbocharged in 2023. And then we're going to talk about how to identify recession-resilient real estate markets, right? As we move into what is likely going to be a recession, how do we identify real estate markets that are going to be resilient during a recession? Then we're going to talk about 4 reasons to buy turnkey rental properties. I'm going to talk to you about how to conduct out-of-state due diligence. And then I'm going to share with you the market where I just bought a rental property and where my business partner currently has one under contract as well. Same market. I'll tell you what market that is. And finally, we'll conclude with the #1 mistake that real estate investors are making right now and how to avoid that. And then we'll take the live Q&A. So that is what we've got on the docket for today. So let's dive right into this, okay? When you look at the actual data of what is going on in the housing market today, I'm going to show you exactly what that data is. What you will find is that there are no signs of an imminent housing crash, okay? There's a lot of people talking about, oh my gosh, are we in a giant housing bubble? Is it going to be 2008, 2009 all over again, right? So let's just be clear. Now, obviously, housing prices are not going to go up forever at the same rates that they've been going up the last 2 or 3 years. We know that. That's for sure. And also, some markets are more cyclical, right? They are more cyclical and other markets are more linear and all that kind of stuff. So there's all sorts of variations within the US real estate market, but are we on the verge of a giant epic housing collapse in the same way that we were in 08 and 09? Absolutely not, according to the data. Let's take a look at the data and ask, why is that the case? Primarily, that is the case because homeowners are simply not distressed, like not at all distressed, right? If you look at the mortgage stats in 2023, 97% of mortgages are performing, only 3% are delinquent, only 0.5% of home sales are foreclosures. The average credit score of a mortgage borrower today is 728. That is in the excellent credit category. 37% of properties have no mortgage at all, right? They are owned free and clear. So those buyers are not going to be distressed at all. And then 98% of the mortgaged homes have positive equity. And the average loan to value of a house that somebody lives in today in the United States is 44%, meaning that the average homeowner has 56% equity in their home, which comes out to an average of $300,000 of equity in the average home, which is an all-time high. So the market could go down 56%. These homeowners still would not be underwater on their homes, okay? So that is really, really, really important to understand. Homeowners are not distressed. They are not being forced to sell their homes. This is entirely different from what the environment was like in 2008, okay? Also today, we have severely limited housing supply. Most people consider an average, balanced, healthy real estate market to have about 1.5 million properties available on the market, okay? Today, we have just over 600,000. That is less than half of what would be considered a healthy, balanced market. So we are currently still in a severe housing supply shortage. Now, so we understand the housing supply situation, okay? Let's now look at what is going on with mortgage rates. There's a lot of discussion about rising mortgage rates. What you need to understand is the way that these rising mortgage rates benefit today's rental property owners, okay? First of all, mortgage rates are still historically low. Let's be super clear about that, right? A lot of people are comparing today's mortgage rates with mortgage rates from 2 years ago, which were the lowest in the history of the United States, right? So they're not as low as they were 2 years ago, but they are, historically speaking, still very low. I'm going to show you a chart in a minute of what mortgage rates over the last 50 years looked like, and you will be able to see exactly where we are today in a historical perspective. Also, rising mortgage rates correspond with increased rental demand, okay? Those prospective homeowners who were getting ready to buy an entry-level home at the mortgage prices 2 years ago, and what that mortgage expense would have been, some of them are now priced out of the mortgage, of the housing market, because that mortgage is now going to be more expensive. They can no longer afford it. So now they are renters. So it is increasing the rental pool, and that is increasing rental demand and putting upward pressure on rents, okay? Rising mortgage rates have also historically corresponded with rising home prices. Every single time, all 6 times that the Fed has raised interest rates since 1994, all 6 of those times, those rising interest rates have corresponded with rising home prices. Now, why might that be the case? Well, if you are a homeowner and you have a low mortgage locked in on a fixed rate 30-year loan, you know that if you were to sell your house, you would lose your mortgage. And then even if you bought a house that was the same price, you'd have to get a more expensive mortgage that would be a higher expense to maintain that house. And so when mortgage rates go up, people that have low fixed rate mortgages understand that that mortgage note is the asset, and they want to hang on to that mortgage note at all costs and not sell their house. So they are incentivized to keep their house off the market. That is further constraining supply and therefore further helping to drive home prices up, okay? And then the other really important thing to understand about mortgage rates is that the real, meaning inflation adjusted, mortgage rates are actually lower today than they were 2 years ago. I'm going to show you what that looks like as well. Okay, first though, let's take a look at this historical mortgage chart. These are mortgage rates over the last 50 years. So you can see today's mortgage rate, yep, it's higher than it was 2 years ago, but historically speaking, it is still historically a low mortgage rate. Okay, that's important to have that perspective. Now let's take a look at the inflation situation here and how that impacts mortgages. 2 years ago, February 2021, you could get a rental property being mortgaged for about 4%. Now remember that a mortgage on a rental property is going to be about a point or so higher than a mortgage on a primary residence. Okay, so a rental property mortgage 2 years ago, you could get that for about 4%. The inflation rate in February 2021 was 1.7%. Okay, so when you subtract the inflation rate from the mortgage rate, your real inflation adjusted mortgage rate 2 years ago was 2.3%. Today, rental property mortgage rate, maybe let's say you get a 7.5% mortgage today, but the rate of inflation is 6.4%. So when you subtract that, the real inflation adjusted mortgage rate today is only 1.1%, which is about half of what it was 2 years ago. It's actually lower when you take inflation into account. Okay. So what I want to do now is dive deeper and talk about, now that we have that context, let's talk about how 2023 trends are turbocharging the advantages of owning rental properties. And again, we're talking about buying and holding long-term rental properties. Okay. First of all, in order to talk about how advantages are being turbocharged in 2023, we have to first talk about what the regular advantages are to buying and holding rental properties. Okay. When you buy and hold, not flip, hold residential investment property, you have 5 profit centers simultaneously working for you at the same time. This is fundamentally unique. This is what makes buying and holding residential investment property a asset class that is fundamentally different from any other asset class, right? It is what we call a multi-dimensional asset class. Normally, when you buy an investment, you buy, let's say, a stock, all you can do is hope and pray it goes up in value. That's it. You know, if it does, okay, you can make some money. You have to, of course, sell it, then pay the capital gains tax, and then hope that whatever's left over beats the rate of inflation. But if it does, okay, you can make some money with that. But if it goes down, you're pretty much out of luck, right? Now, sometimes you can have a second profit center, right? If you have a dividend paying stock, it can, you can make dividends as well. Sometimes there's 2 profit centers. But when you buy and hold rental property, you have 5 working for you at the same time. The first one is your positive cash flow. So your tenant's rent, if you buy right, your tenant's rent should cover all of your expenses, plus it should cover an estimate for maintenance and vacancy. And then it should have positive cash flow coming to you passively on top of that every single month, a stream of income. Then you have the market appreciation. If home prices go up in value, you build equity through market appreciation. But you also have your tenant paying down your mortgage principal every month, because remember, your tenant's rent covers your principal and interest mortgage payment. So let's just say, for example, that you bought a property and it didn't go up in value a single dollar over 30 years. It's never happened in the history of real estate, but let's just say hypothetically for this example, it happens to you. Well, guess what? Your tenant would have paid down your entire mortgage, would have paid it off entirely. You would own the house free and clear. You would have built all that equity anyways without market appreciation, which is why it is a separate profit center. Okay, then you have the tax benefits, right? Now, when you buy and hold, not flip, hold residential investment property, it becomes the most tax advantaged asset class in the United States. The government wants to incentivize you to provide housing for your fellow citizens so that they don't have to do it. And they will give you extraordinary tax incentives if you're willing to do that. For example, they allow you to depreciate the structure of your property, even if it's going up in value. And then when you go to sell your property, they allow you to do what's called a 1031 exchange, which means if you sell it and reinvest the proceeds into other like-kind properties, you can indefinitely defer all of your capital gains tax, all of your depreciation recapture, and you can keep doing this all the way until death, at which point your heirs inherit the property, the basis resets, and nobody ever needs to pay that capital gains tax. And then finally, number 5, when you buy and hold rental property, you can profit from inflation. And this is really, really, really important to understand right now in a high inflationary environment. Okay. Why is that the case? First of all, home prices rise with inflation. Second of all, rents rise with inflation. And third, when you borrow money for a 30-year fixed rate mortgage, you are borrowing that money in today's real dollars, but you are paying the bank back in future diminished nominal dollars that are worth less than the ones you borrowed. Okay. The higher the rate of inflation is, the more that debt gets debased. Okay. So inflation is normally insidious for people that have their money in a bank account, because it just destroys your wealth. It just destroys your buying power. And it's really insidious if your money is in the bank. Now, if you take your money out of the bank and you put it into a rental property with a 30-year fixed rate mortgage, now you are on the other side of the inflation equation, okay? And so instead of destroying your wealth, inflation is destroying your debt, okay? So you are profiting from inflation. You are on the other side of the inflation equation. The higher the inflation goes, the more you profit if you are holding a rental property with a 30-year fixed rate mortgage. Now, real estate is also the most debt favored asset class. Okay, you can get a mortgage and use the bank's money to acquire your property, right? About 80% of the property, you can use the bank's money to acquire it. But even though you may have only put 20% down, you get 100% of the appreciation. So let's say that the housing market slows way down and the market where you buy only goes up 5% next year, okay? So let's just say you paid $100,000, you bought a $100,000 house, you put $20,000 down, and closing costs, let's say, is $25,000 out of pocket, and the housing market only went up 5%. Well, guess what? You only put down $25,000. So when it goes up from $100,000 to $105,000, that $5,000 gain, that 5% market increase becomes a 20% return on your cash invested, because even though you only put down 20%, you get 100% of the appreciation. So all the market has to do is go up 5%, and then you have a 20% return on your cash invested. And that's just from this one profit center. That's just from the market appreciation. That doesn't count all the other ones we talked about, right? Those are on top of that. And then, as we mentioned, you borrow the money in today's real dollars, you pay it back in future dollars that are worth less than what you borrowed. And so the higher the inflation goes, the more it debases your debt and the more you profit from that. So today, the official rate of inflation, a lot of people think the real rate is much higher than this, but let's just be very conservative and use the official rate is 6.4%. Now, the official rate of inflation from 2010 to 2020 averaged 2% a year. So a 6.4% rate of inflation is over 3 times what inflation was in the last decade, okay? And the higher the inflation, the higher the profit for the owner of the rental property, okay? So that is why this is what we're talking about in 2023. These advantages of buying rental property are turbocharged. The inflation rate is 3 times what it was a couple years ago, okay? And there is upward pressure on home prices. Right now, the age demographic of Americans who are at that first-time home buyer age is the highest it has been in decades, okay? But there is a supply constraint of available homes, and this is particularly acute at the entry-level home prices, okay? New construction home builders are less incentivized with these higher interest rates to build entry-level homes because the profit margin is much smaller for them on those homes. So with higher interest rates, it gets even smaller. They are more inclined to want to build very expensive custom luxury homes and that sort of thing, right? And so there is a really particularly acutely severe shortage at that entry-level home price. And as we talked about, rising mortgage rates further constrain supply. They constrain resales because people that have low mortgage rates locked in don't want to lose those mortgages, so they don't want to sell their home. So there is a constraint on the resale houses as well as the new construction ones, okay? Also, rents are soaring and vacancy is at a historic low. Normally, you might renew your lease every year, raise the rents 2%, 3%, something like that. Over the past year, rents increased 12% for new tenants. When a tenant moved out and they leased it to a new tenant that moved in, there was a 12% increase in the rent, okay? And remember, the housing shortage is driving people to rent, either because there's not homes available that people can afford in that entry-level price point, or because the mortgage rates are higher and they were about to buy and now they can't because the mortgage rate is causing their payment to be too high, so now they are renters. A lot of these forces are driving people to rent, which is creating more rental demand, which is driving the rents up. And vacancy rates are at the lowest level right now that they have been in 35 years. Take a look at this graph. That is the 35-year history of vacancy rates in the United States. And we are now at a historic low. So all of this is uniquely beneficial, historically beneficial for rental property investors right now in 2023. Okay. So since we now understand that, and we now understand how advantageous it is to buy today, let's talk about where we want to buy. Okay. So we know that we are approaching, whether you want to call it officially a recession or you don't want to use that language or whatever else, we are certainly in and further approaching a recessionary-like environment. Okay. Whether it's going to be official or not, we'll see, but we're in a recessionary-like environment. And so as real estate investors, we want to identify markets that are recession resilient, that are going to perform well for us during recessionary periods. Okay. So the first thing we want to look at in a market, macroeconomics, right? Demand drivers. We want to look for markets that have job growth, population influx, low unemployment, diversified economies, increasing per capita personal income, lower than average cost of living, revitalization projects, these sorts of things. Okay. And then we want to look at the real estate fundamentals in these markets. Okay. So the first high level metric to look at a glance is the price to rent ratio, often called the rent to value ratio, where you simply take the purchase price and you divide it by the monthly rent. Okay. So if you have a $500,000 property that rents for $2,500 a month, your RV ratio is 0.5. On the other hand, if you have a $100,000 property that rents for $1,000 a month, your RV ratio is 1%. Obviously, the 1% RV ratio is better than the 0.5, right? Very high level metric and gives you a sense at a glance. If you compare, San Francisco with Kansas City, the RV ratio is going to be pretty glaring in terms of how different that's going to be, right? But we have to go a step deeper than that, all right? And we have to understand what are the expenses in these particular markets, okay? And this is where we have to look to the capitalization rate, because the capitalization rate shows us the net operating income divided by the purchase price, okay? So we take the tenant's rent, we subtract the property taxes, the insurance, the property management fees. If you happen to have any HOA fees or owner-paid utilities or landscaping or anything like that, subtract it all, and then subtract an estimate for vacancy and maintenance, and then you will have your net operating income and divide that annually, right? Your annual NOI, divide that by your purchase price, and there you have your capitalization rate. Now, this is an important metric because if you're just looking at price to rent ratios, it can be misleading, right? There's a lot of sort of novice people that, new investors that gravitate towards simple metrics, like somebody tells them, oh, hey, you should look for a 1% rule, like if the rent is 1% of the purchase price, that's what you should look for when you buy. And people go out and then they just start looking for that. But here's why some of those metrics can be a little bit misleading, right? So let's say we have property X, which is $100,000 and it rents for $1,000 a month, and property Y is $100,000, same price, but it rents for $900 a month. Which one would you rather have? Well, most of us would say we want property X. Clearly, that's a more advantageous price to rent ratio. And in fact, it is a more advantageous price to rent ratio. But what if I gave you more information? And what if I told you that property X is located in New Jersey, where the property taxes are $2,490? And I told you that property Y was located in Alabama, where the property taxes are $410. Everything else being the same, insurance the same, property management percentage the same, maintenance estimate, vacancy estimate, all that stuff, the same percentages, just located in a different state. Okay, what happens? Well, as it turns out, in this case, property Y has a cap rate of 7.3, property X, a cap rate of 6.2. Clearly, property Y is the better cap rate when we go to that next level. So that's why it's always important to go to this deeper level when we're analyzing properties. The other thing you want to look at is property cycles. Okay. So we've been doing this, as I mentioned, for 16 years, right? So when I think all the way back, I think what was our most popular markets in each of these different years, right? And I can tell you what they were. So 2011, our most popular market was Phoenix, Arizona. It had just come out of the crash. You could buy incredible near new construction properties there for below builder replacement cost and rent them for really good amounts and lock in those price to rent ratios. It was fantastic. Our clients that bought there in 2011 crushed it. They've appreciated significantly since then. They're doing great. But the prices went up so much and the rents did not go up as much as the prices did. So now it does not make sense to continue buying there because you're paying a lot more for the properties. You're not getting proportionally more rent. So the cap rates have been squeezed in a process called yield compression, right? When home prices rise a lot faster than rents, you buy for a lot more, but you're not getting a lot more rent for it, right? Yield compression. So, and this happened in all these different markets, right? 2012, our most popular market was Atlanta. 2013, it was Houston. I mean, I could continue to go on. 2014, it was Dallas. I mean, I could continue to go on with what all these markets were back then when they made a lot of sense to buy there. Now it makes less sense to buy in these markets because they're so expensive and you're not getting those corresponding rents that are going to make it make sense from a cap rate perspective, right? So here's a chart just to give you an example. The top graph is the Phoenix, Arizona market, and the bottom one is the Indianapolis market. And that gray line down the middle that you see is the Great Recession of 2008, 2009. Okay, so look at what happened to the Phoenix market in the Great Recession, right? It cratered all the way down, you know, like a roller coaster to the bottom there. You can see the 2011 bottom when all of our clients were buying there and how well they did when they bought in 2011. But look what happened to Indianapolis during the Great Recession, right? 08, 09, right? The most catastrophic, thing in my lifetime that happened. Look what Indianapolis did. Went down about 7% or so, maybe, and then kind of floated along and then, went up, right? So a market like Indianapolis was much more resilient during that recessionary period, okay? So that's very instructive, right? In terms of the types of markets that we want to look at when we are moving into a recessionary period, right? So now let's talk about 4 reasons to buy turnkey rental properties. And just to start off with a definition, this is kind of a buzzword that's thrown around now by a lot of people. So let me tell you what we mean by it. When we say turnkey, we mean a property that is either brand new construction or fully renovated, and it has a long-term tenant in place, and it has a local property management company that is collecting their rent, handling the maintenance, right, managing the property on your behalf so that you do not have to be the rehabber or the landlord or live near the property, okay? So the first reason that our clients like to buy turnkey properties is the value of their own time, right? Landlords deal with tenants' toilets and trash. Real estate investors make decisions in cash checks, and our clients want to be real estate investors. They value their own time. They're not trying to create a job for themselves. They're trying to get a good investment, right? Number 2, dramatic risk mitigation, right? When you buy turnkey properties, you are letting somebody else absorb the risk of acquiring a distressed property, pricing out the rehab, possibly letting it go over budget, managing the renovation, borrowing hard money, absorbing the holding costs if that renovation takes longer than expected, absorbing the upfront vacancy loss if it takes longer than expected to lease the property to a tenant. Let somebody else absorb all that risk. You get to just leapfrog over all of that, come in, evaluate the deal, conduct your due diligence on the deal. You're going to have a home inspector go in there, have an appraiser go in there, all that stuff. And then when you close, you're closing on a performing, stabilized property that cash flows from day one. And that is what our clients like to do and reduce their risk by doing that. Number 3, you get to leverage the economies of scale of professional turnkey companies. So the way that this works, we are a real estate brokerage and we have relationships with professional, independently capitalized multi-million-dollar companies that do this professionally at scale. They acquire multiple properties at the same time. They buy their renovation materials in bulk and get discounts on that. They run their own construction crews, so they have efficiency, economies of scale with all of that. And they do this professionally, full-time at scale, okay? And so if an individual person is trying to do this, that's basically who you're competing with, right? And because they're able to buy so many properties for cash, they're going to get access to buy all of the best properties first. So you're probably buying something that they didn't want. And even if you do get something that's as good as they get, you're still not getting the same discounts on the materials for buying in bulk and the efficiency of the construction crews and everything else, right? So leveraging the economies of scale is what you get to do when you are buying through professional companies that do this at scale. And then finally, you get to remove the geographic restrictions and buy in the best markets, regardless of where you happen to live, right? So you should be able to live wherever you want to live or wherever you need to live, for your job or your family, and then not let that restrict you from being able to buy in the most advantageous real estate markets, right? Now, we do get a lot of questions on, well, if I'm buying out of state, how do I conduct my out-of-state due diligence if I don't live near the property, if I can't see it and touch it? How will I know that, it's a good deal? And the answer is exactly the same way you would conduct your due diligence if you're buying a property down your street. Because unless you are a professional home inspector yourself, you would use third-party professionals to evaluate every single part of that deal on your behalf. And you would do exactly the same thing if you're doing it out of state. Okay, so first thing we encourage our clients to do: independently verify all of your operating expenses, right? Your property taxes, it's publicly available to verify what they are. You're getting a quote directly from your insurance company. You're getting a quote directly from your mortgage company. Then verify your rents, right? Verify the lease that your tenant signed. They are actually paying that much rent. Then verify that the rent your tenant is paying is actually the market rent, meaning that if they were ever to move out of their property, you could reasonably release that property within 30 to 45 days because it is in fact the market rent, right? So there's other tenants that would be lined up waiting and interested in renting that property for the same amount, okay? One way that you can do that, there's third-party resources, right? One of the ones that a lot of our clients use is called Rent Facts. You can check this service out if you haven't used it yet. This is an affiliate link of ours whereby if you use it, you'll actually be able to pull a free report on any property address in the United States. So just for fun, if you want to just see what it's like, you can pull one, maybe even on a property that you're familiar with. Like if you own a rental property, you're like, hey, let me see what it has to say about my property, right? You can just do that and just get a sense for like the type of info it'll get you. Or if you're actually evaluating a deal right now, maybe use it for that one. But what it does is it'll show you, it pulls in rental information about like what would the market rent be for this property, which way is vacancy trending, but it also pulls in stuff like the school districts and the crime rate and like all of this different stuff. So you can evaluate the risk of that particular micro market and get detailed information at the address level about that property. So we encourage our clients to use services like that. And then another technique that I think is great is interviewing multiple property management companies, right? And this is great because this is really a third party thing, because you can just call up a local property management company, and any major city has tons of property management companies, right? And just say, hey, I'm thinking about buying this property. I'm interviewing companies, to decide on a management company. Can I ask you a few questions? And in your questions, you could ask them, how much do you think you could rent this property for? How long would it take you to lease this property? How much demand do you have for a property like this? And then you could say, maybe you're deciding between 2 or 3 properties. And you can say, hey, if I was to give you one of these 3 properties, which one would you be most excited about managing? Which one do you think you'd have the highest demand for? And you could lease the quickest out of these 3, right? And so that can help you with buying decisions. It can help you with due diligence. You can get a lot of local intelligence on the neighborhood area and the rental demand and which way things are trending just by interviewing local property managers who are not in any way involved in selling you the property. So, it's a very, very independent source, right? And then, of course, you're going to order a home inspection, right? And of course, you're going to have an appraisal, right, on the property, all that kind of stuff. And so these are the third-party mechanisms that you can use for conducting your due diligence. So with that, let's now talk about where did I just buy a property and what has been our most popular market, okay? Right now, over the past year, what is our most popular market right now where I just bought? It is St. Louis, Missouri. And so let me dive in and show you why that is the case and break this down using some of the concepts that we just discussed, okay? So first of all, St. Louis is home to 8 Fortune 500 companies. The gross domestic product has increased 29% in the last decade. It's now over 170 billion. And St. Louis cost of living is 12% below the national average, okay? It's ranked top 10 most cost competitive large MSAs to do business, ranked top 10 large American cities of the future, and the unemployment rate is well below the national average. So there is a stable pool of qualified tenants. Now, take a look at this. This is the latest statistics from Mortgage Monitor. St. Louis has the #1 home affordability ranking, meaning mortgage payment as a percentage of income in St. Louis, #1 in the country among large MSAs. And St. Louis has rising per capita personal income. Why is this important? Well, if you want to raise your rents every year when you renew your lease, you need to make sure your tenant can afford to pay those higher rents, right? If you want to sell your house for more than you bought it for down the road, it's important that people can afford to pay more than you bought it for down the road. So rising personal income is an important statistic. Home price appreciation in St. Louis over the last year, 13%, right? So if you put, if you bought a $100,000 house, put $20,000 down, closing costs, say you put 26 grand down, 13% appreciation is $13,000 in equity on a $26,000 out of pocket. That is a 50% return on your cash invested just from the appreciation alone, not even taking into account any of the other factors. Okay, so let me show you guys the property that I personally purchased. Now, I purchased this right off of the Maverick Investor Group website, exactly the same way that every single one of our clients buys their properties. There's plenty more like this. I have a number of my clients that bought in the same area. We're neighbors, and there are many more like this that we have available now. Okay, so let me show you what this looks like. So this is the property that I bought. A fully renovated price, $102,000. Now, this is in a nice suburban, majority owner occupied area of St. Louis, and it rents for $1,000 a month, right? So 3-bed, 1.5 bath house. This is what the interior looks like after the renovations, right? So remember, everything is renovated before you close on your property, and this is the renovation standards that they're doing on all of these St. Louis properties. So this is what the interior looks like. And then this is what my numbers look like. Okay. So with the $102,000 purchase price, if you're not using a mortgage, about $3,000 closing costs. If you are using a mortgage, you add lender fees to that. So out of pocket, about $105,000 plus any mortgage fees if you're using a mortgage. I'm just showing you the cap rate calculation here. So the gross monthly rent, $1,000, subtract the property taxes, the insurance, the management fee. I'm going to just assume vacancy rate about 7%, maintenance about 5%. I'm actually not expecting any of that in the first year because it's newly renovated and the tenant just moved in. But over time, when I hold this over the long run, eventually I'll have maintenance and vacancy. So I just want to factor those things in there. So I'm not surprised by them. So the net monthly cash flow, again, without the mortgage, $618. And then that means the cap rate is a 7.2%. So, by the way, folks, if you are interested in these types of properties, we are doing a private buying opportunity event for St. Louis properties. And if you'd like to register for that, you can do that. I want to offer that to you at maverickinvestorgroup.com/STL webinar. Okay. So when we do these webinars, basically what they are is a private buying opportunity event. And we have the provider on the webinar with me, okay? And so we do a deeper dive into the market and talk about the market dynamics and why it's advantageous for investors. And then we talk more specifically about the renovation standards and the property management experience for out-of-state owners and all that kind of stuff. And then you can ask your questions live directly to the provider, and we can have a discussion and all that kind of stuff. And then it's actually a live buying opportunity event that you can actually reserve properties, okay? And then start moving forward on your due diligence. And so I want to invite everybody here to attend this webinar. We're going to do it a week from today. Okay, so if you like this, if you're good with a Saturday webinar, obviously you're here. This is next Saturday. This is the webinar we're going to do. And I want to invite all of you to be a part of that, okay? And now we're going to close this out by talking about the #1 mistake that real estate investors are making right now. and then we're going to open it up for questions. The number one mistake people are making is not buying, right? They're waiting to buy. They're hearing things on the news. They're saying, I don't know, is there going to be a housing crash? Is it going to be this? Is it a good time? Maybe I should wait. And people were saying that to us last year. And then now they're like, oh man, I should have bought last year, right? And people were saying it the year before that, right? And so forth. And people are always saying this. And the reality is that as long as you buy right, it is a good time to buy real estate, because the way that our clients buy real estate is they make their money when they buy. Okay. So as long as you're doing that, then of course it's a good time to buy real estate, right? Because you are locking in a stream of income. So you're starting to cash flow the day that you close. You're starting to depreciate your property and take the tax benefits the day that you close. Your tenants are starting to pay down your mortgage principal the day that you close. It's a very high inflationary environment. So the inflation is starting to destroy your debt the day that you close. So all of those benefits are kicking for you from day one, right? And if you are planning to buy and hold this, then you don't really care what exactly the market does, 6 months from now, 12 months from now, 24 months from now. It doesn't really matter. Short-term market fluctuations are not in any way impacting your cash flow, or these other profit centers, right? So if you're going to say, yeah, I'm going to buy this and hold it for 10 years, then it is an incredible time to buy. And the other thing is, when you get a mortgage today, you are in the driver's seat. So you're locking in that mortgage. Guess what happens if mortgage rates go down a year from now? You can refinance and get a lower rate mortgage and lower your expenses. And then guess what happens if mortgage rates go up again after that? The other person is stuck with it and you get to keep your low mortgage rate. Okay. So you are in the driver's seat with these mortgage rates. All right. So just remember that. Now I want to finish here with a special offer for the Realty 411 community. We have been working, as I mentioned, with Realty 411 folks for well over a decade. Linda and I have known each other for 15 years. We've been helping a lot of Realty 411 clients build their portfolio, diversify across markets, all that kind of stuff. And we would love to help each and every one of you as well. The first thing, though, the way that we operate is a very customized approach, a very relationship-based approach. We want to get to know you personally. We want to answer your questions. We want to understand your buying criteria. We want to understand your real estate investing goals, and then we want to help you to identify the markets and the properties that are the best for you, and to get you on a track to build your real estate investing portfolio, whatever pace that is, right? For you, we want to support you in doing that, and we do that in a very individualized and customized way. Through starting off, step one is a video consultation. So I want to encourage you and offer you to register for a free video consultation. Just go to maverickinvestorgroup.com/R411. And there you'll be able to register for a video consultation. There's a calendar. You can select a date and time that is convenient for you. And that's how we'll get to know you and get to understand exactly how we can best support you. We have a relationship. In addition to the access to the properties, we also have relationships with preferred lenders who specialize in working with real estate investors. So if you need to qualify for financing, if you want to see what type of rate and terms you would get on a mortgage, we can introduce you to a preferred lender. If you need to talk to a private lender about commercial financing, right? If you want to buy in your self-directed retirement plan, or you need something else, we have relationships with all of those lenders we can introduce you to, right? We are there to walk you through step by step through the entire process, give you access to resources, support you through your due diligence, all of those types of things. And that's how our business model works. And none of this, by the way, costs you any money, okay? Because Maverick is a real estate brokerage. And the amazing thing about the way that real estate brokerages work in the United States is that 100% of the broker fees are paid by the seller and the buyer pays nothing, right? I was amazed when I found this out, because I started buying rental properties back in, almost 20 years ago. Started buying rental properties, and then my friends started asking me, how are you buying all these rental properties? And I started showing them how I was buying rental properties and helping them buy rental properties. And I realized that the real estate brokers that were helping us buy these rental properties were all getting paid commissions, but we weren't paying them. And I was like, oh, well, that's cool. I was like, that's really cool, because they're helping us, they're adding value, and they're getting paid for that value, but they're not, but we're not paying it. So it's like, that's cool. So then when I started my own business and I co-founded Maverick Investor Group, I realized that I could literally just, if I had a broker's license, I could just continue helping my friends buy rental properties, not charge them anything, but get paid, make money, and run a business. And I was like, that is for me, sign me up, because I don't like selling stuff. I especially don't like selling stuff to my friends. So if I can just help people buy real estate, help them build their wealth, charge them nothing and get paid for it, like that's the business model I want. And so that's what we've been doing ever since. And so all of our services are free to you. The only time we get paid is if we're able to deliver enough value that we're able to help you identify the right property for you. You go through all your due diligence, you say, yes, everything is good, and you close on it. Only then do we get paid. If we can't deliver that value, we make nothing. But even when we get paid, it's not by you. Okay. So you can just feel very comfortable and secure in that you're not ever going to have to pay Maverick any money. We don't ever touch your money or handle your money or anything like that. We are just here to provide value and support you on your journey. And then, as Linda said at the beginning, we donate 10% of our net revenue to charitable causes and things that we care about. And that incentivizes us to, build a company and do well financially, because the better we do financially, the more, charitable causes benefit from that as well. So that's how we operate. And with that, I want to open it up now for your questions. Here again is the link for the free video consultation. Want to encourage everybody to sign up for that so we can at least get to know you, make a connection, see if it's a good fit to work together, see if we can deliver you some value at no charge to you. So I encourage you to do that, maverickinvestorgroup.com/R411, and then go ahead and type your questions into the chat box if you want. I will start to read them out and answer them. Okay.
Fantastic presentation, Matt.
Oh, thanks, Linda.
And I encourage everyone to please ask your questions. Matt is here for you to help you turbocharge your real estate portfolio in 2023. And I'm going to come on real quick to say Matt is the real deal. He travels around the country and has an amazing life, a life of freedom and exploration. I mean, it's an incredible lifestyle. So it's been a pleasure to see him and his partners evolve in their business the last 15 years I've known them. And I can say without a doubt that they truly live their business model. And that's what I wanted to say.
Oh, thanks, Linda. I appreciate that. Yeah, so let me start tackling some of these questions here. We got a question that says, so despite the fact that in LA, housing prices have gone down a bit, in St. Louis, it appreciated by 13%. That is exactly right. So the data for that is coming from the Federal Housing Finance Agency. They do a house price index. They publish a quarterly report. You can check that out. The St. Louis housing prices over the last 12 months have gone up 13%. So it is really important to understand. And as I mentioned in the very beginning, some of these markets, all right, St. Louis is more of what we might call a linear market, right? So it's a more recession resilient market, similar to Indianapolis. I showed you a graph for Indianapolis versus Phoenix. If you put St. Louis versus Los Angeles, and I lived in LA for 7 years, by the way, so I have a lot of love for LA. I have owned property myself in LA, so I'm pretty familiar with it. And I have a lot of love for the city of Los Angeles, but buying rental property there compared with buying it in some of these more investor advantaged, more recession resilient markets, you're going to find a lot of advantages by buying out of state. So a lot of our clients live in California because they love to live in California, or they want to live in California, or they need to live in California, but they're buying rental properties in out of state markets where you can just get a lot more, a lot more bang for your buck when you're doing that. Okay, is Maverick just about single family, or do you guys buy larger multifamily as well? So we specialize in, thanks for your question, Nick. We specialize in residential investment property, which is defined as either single family homes or 2 to 4 unit properties, right? So these are the assets, first of all, that you can get conventional mortgages on. So the lowest down payments, the most advantageous rates, that kind of stuff. Also, these are the types of assets, when you're buying single family homes, there's a lot of advantages to that over multifamily. Right now, that's not to say commercial is bad or things like that, but a lot of the reasons that our clients would prefer to build a portfolio of 20 single family homes instead of buying a 20 unit apartment building, number one, is that single family homes generally tend to appreciate better. Number two, when you're going to sell it, you can typically sell a single family home to a retail end user, meaning an owner occupant that's going to move in and live there, which means you can typically sell it for a retail price. A lot of times, if you're selling commercial stuff, it's another investor, they want a deal, all that kind of stuff. Different type of exit strategy. A lot of people prefer that. And then also, if you had a portfolio of 10 or 20 single family rental properties, you can do what's called a segmented liquidation strategy, meaning that if you own a 20 unit building, all you can do is hold it or sell it. Those are your only choices, right? If you own 10 or 20 properties, well, now you can sell one or two. Maybe they went up in value a lot and you want to harvest that equity. Or maybe one or two are not performing very well. You want to
Hi, Matt. I think you're